Max, let me begin with
Thank
you.
you.
What is your best guess as to when the Fed may start cutting rates and how many times this year?
Well, thank you for having me. But I think if you listen to the federal chairman Powell, he's telling you that they need more information. And we think inflation's stickier on the way down. This last 1.5% or so that they're looking for, it's going to take time. So we could see potentially 25, maybe even up to 50 basis points cut by the end of the year. But we would be surprised to see it before the fourth quarter. And we think people are just overly optimistic. That's what's just happening here today is people have built up such an expectation of rate cuts that anything that throws a monkey wrench in it's going to scare them, especially at these valuations. But I don't expect the cut if you have one until the end of the year.
Bryce, can the stock market continue to make headway if the interest rate environment isn't a matter of sort of settled policy?
No, I think the equity market has to deal with these headwinds because of the uncertainty. Uncertainty always, drives equities down, or at least certainly keeps a lid on the broader markets. As a bond investor, it's win-win either way. You get to earn a higher yield for longer, and these most investment-grade bond yields are at very nice, attractive real yields over inflation still. So it's not a problem there. For the Fed, it's lose-lose. They are part of the problem. So they're driving up costs for businesses. Businesses are having to finance inventory at 8 to 12%. Those costs gets passed through into cost of goods, which drives up inflation. And then, they have mortgage rates up so high, it's causing housing to be expensive. The shelter component was really bad this morning. So for them, it's like they're their own problem.
So it's a nice time to own fixed income, Bryce. I hear you saying. I'm going to ask you where in fixed income I might be the most profitable investments, but let me make sure I'm understanding here. You think that you don't think, even though rates have gone back up from where they were a few weeks ago, you don't think that we're going to test the high yields from last fall, do you?
No, I don't. I think we're past the peak in rates, and that it's just a matter of time before investors kind of realize that it's inevitable that yields will come down. I like looking at the 2-year Treasury.
Okay,
oh,
go ahead. No, I was going to ask you where are the sweet spots in fixed income right now?
Yeah, I love the belly of the curve because the 2-year maturity always is looking at where Fed funds will be 2 years from now. So let's say come this summer, let's say June. People are going to expect the Fed funds rate to be a lot lower 2 years from June than they are now. So that 2 to 6 year part of the yield curve is going to do really well between now and then. And that's where we like to be. And we like the mortgage sector in particular. You can get government agency guaranteed mortgages over 5% right now. And you'll probably get a little bit of price appreciation as the spreads narrow with banks kind of coming back in and competing for loans again. All of that will be beneficial for that sector.